The market didn't teach me about cycles with diagrams or tidy phases. Kid, it taught me by letting me believe one environment would last forever, and then tearing that belief apart without warning, because the most dangerous assumption a trader can make is that what's working today will keep working tomorrow. In my early years, I treated every market the same way, like a stubborn craftsman using one tool for every job, convinced that consistency meant never changing my approach. That illusion held just long enough to build confidence, and then the cycle turned quietly at first, the way it always does, and my edge began to dull without me realizing it. The first time I truly felt a cycle shift was after the dot-com fallout, when momentum that once rewarded aggression suddenly punished it, and trades that used to explode upward now fizzled out or reversed without mercy. I remember thinking the market was broken, that something external was wrong, when in truth it was my refusal to adapt that was failing me. Markets move in seasons, not straight lines, and each season rewards a different behavior. Expansion rewards risk-taking. Late-stage cycles reward caution. Contraction punishes speed and size. Recovery rewards patience. But understanding that intellectually and living it emotionally are two very different things. I learned the hard way that cycles don't announce themselves with headlines. They reveal themselves through subtle shifts, breakouts that fail. More often, trends that shorten volatility, that changes character correlations that tighten. At the time, I ignored those tells, because adapting felt like admitting my old approach was no longer good enough, and pride has a way of disguising itself as conviction. Then 2008 arrived, and the lesson was delivered with a sledgehammer. Strategies that thrived in orderly markets collapsed under fear-driven volatility. Mean reversion stopped working. Trend following turned savage. Liquidity vanished when it was needed most. That period forced me to confront a truth that still guides me. Today, cycles don't care how long you've been right. They only care whether you're aligned with what the market is rewarding now. I watched traders cling to familiar tactics because they had worked for years, and I watched them bleed out slowly, not from one bad decision, but from 1,000 small refusals to adapt. That's when I began studying the market less like a puzzle to solve and more like a living system to read. I stopped asking, "Is my strategy right?" and started asking, "What is this environment paying for?" Sometimes the answer was volatility, expansion, sometimes compression, sometimes patience, sometimes, inactivity. Learning to stand down became as important as learning to engage. During long grinding ranges, I learned to reduce size and expectations. During euphoric phases, I learned to take profits sooner and resist leverage. During panic, I learned to protect capital first and look for clarity later. And when recovery came slow and uneven, I learned to wait for confirmation instead of trying to call the bottom like a hero. The COVID cycle compressed decades of lessons into months. Markets moved from calm to chaos to euphoria at a speed that punished rigidity and rewarded adaptability. Indicators lagged. Old correlations broke. New ones formed overnight. What saved me wasn't prediction, it was humility. I accepted that I didn't need to understand everything to adapt to something. I adjusted risk before I adjusted strategy. I traded less before I traded differently. I watched how price reacted to news rather than the news itself, and slowly I learned to recognize the emotional signature of each phase. Complacency. Before peaks, confusion. During transitions, despair. Near lows. Optimism. During early recoveries. These emotions aren't noise. They are signals embedded in the cycle. The mistake most traders make is trying to trade against the cycle with intelligence instead of aligning with it through behavior. They overtrade late cycles, undertrade early ones, and fight the middle with opinions. Adaptation isn't abandoning your edge, it's expressing it differently across environments. The same core principles, risk control, patience, execution remain, but the application shifts. Size changes, frequency changes, expectations change. And the hardest part is knowing when to change without overreacting. I learned to look for clusters of evidence rather than single signals, changes in volatility regimes, win rate decay, time in trade shrinking, or expanding emotional friction increasing. When those lined up, I adapted not dramatically, but incrementally, respecting the fact that cycles turn gradually before they turn violently. Over time, this approach kept me from being whipsawed by every headline, while still protecting me from staying too long in environments that no longer fit. And here's the part most people miss. Adapting isn't a sign of weakness. It's a sign of respect. Respect for uncertainty. Respect for probability. Respect for the reality that markets evolve faster than egos can keep up. When you finally accept that cycles stop feeling like traps and start feeling like terrain, something to navigate rather than conquer. And as I sit here now, decades removed from my first rigid mistakes, I can say with confidence that understanding market cycles didn't make me smarter, it made me more flexible. And that flexibility is the reason I'm still here. Because the market will always change, but it will only keep teaching those who are willing to change with it. And the moment you stop adapting is the moment you begin trading the past instead of the present. A mistake that always ends the same way sooner or later, when the cycle turns and reminds you that no cycle exists to validate your beliefs, only to test whether you're paying attention. And once I truly absorbed that adaptation, stopped feeling reactive, and started feeling intentional, because I learned that the goal was never to catch every move, but to stay aligned with the rhythm the market was setting at that moment. In later years, I began keeping a quiet journal, not of trades, but of environments, writing down how volatility behaved, how trends matured or failed, how long moves lasted before stalling, and how my own emotions shifted as conditions changed, and that practice taught me something invaluable. By the time most traders realize a cycle has changed, they're already emotionally invested in the previous one. I learned to spot the early friction instead, the subtle discomfort, where trades that should work don't follow through, where patience stops being rewarded and speed starts getting punished, or where aggression that once paid now invites sudden reversals. And when I felt that friction consistently, I didn't argue with it, I adjusted. Sometimes that meant trading less. Sometimes it meant trading smaller. Sometimes it meant doing nothing at all, while waiting for clarity to return. Those decisions were never exciting, but they were protective, and protection is what buys you time. Over decades, I came to understand that cycles are not just market phenomena, they are psychological ones. Traders get conditioned by success in one phase and traumatized by losses in another. And if you don't consciously reset your behavior as the environment shifts, you end up fighting ghosts from the past instead of responding to what's actually in front of you. I watched brilliant people cling to breakout strategies deep into distribution phases, watched mean reversion traders get crushed trying to fade momentum that had turned structural, and watched patient traders miss entire recoveries because they were still emotionally anchored to the pain of the downturn. The market wasn't wrong in any of those cases. It was simply different. The ones who survived were the ones who treated adaptation as maintenance rather than reinvention, making small behavioral changes early instead of dramatic ones late. And with time, that mindset brought a kind of calm I didn't have when I was younger, because I stopped needing the market to behave a certain way for me to feel competent. I could participate when conditions fit, step back when they didn't, and trust that cycles would eventually rotate back into something I understood well. That trust wasn't blind optimism. It was earned through repetition, through seeing enough turns to know that nothing lasts forever, neither good nor bad. And kid, if there's one lesson I hope stays with you, it's this: adaptation is not about abandoning who you are as a trader. It's about protecting yourself from becoming outdated. Because the market will always evolve, and it will reward flexibility long before it rewards brilliance. And if this story helped you see cycles not as enemies, but as context, take a moment to leave a comment with your thoughts. And don't forget to subscribe, so I can keep sharing the lessons the market spent a lifetime teaching me.